Basel norms are international banking regulation introduced by the Basel Committee on Banking Supervision in Basel, Switzerland to strengthen the global financial system. It was first introduced in 1988. These norms provide a framework for capital adequacy, risk management, and banking supervision. Over time, Basel I, II, and III were developed to address evolving financial risk and prevent banking crises. Basel Committee on Banking Supervision. The Basel Committee on Banking Supervision was established in 1974 by the central bank governors of G10 countries in response to global banking disturbances. Operates under the Bank for International Settlements, headquartered in Basel, Switzerland, act as the primary global standard setter for banking regulation, especially in areas like capital adequacy, risk management, and supervision. Provides non-binding guidelines such as Basel I, II, and III, which member countries adapt based on their banking requirements. Promotes cooperation and coordination among national banking regulators to strengthen global financial stability. Basel norms in India objectives. The main objectives of Basel norms in India are maintaining capital adequacy. Banks are required to maintain a minimum level of capital to cover risk arising from lending, investment, and operational activities. Risk management. Basel norms encourage banks to adopt modern risk management practices, identifying, measuring, and mitigating risk effectively. Financial stability. By setting international standards, Basel norms aim to prevent banking failures and reduce systematic risk in the financial system. Transparency and disclosure. Bank must provide clear information on capital adequacy, risk exposure, and asset quality to stakeholders, ensuring trust in the financial system. Global alignment facilitates harmonization of banking standards across countries, enabling Indian banks to compete internationally and attract foreign investment. Basel Accords. Basel I, II, and III. The Basel Committee has introduced three major accords over time, each refining and strengthening banking regulations. Tier 1 capital. Core capital including equity capital and disclosed reserves. Tier 2 capital. Supplementary capital like subordinated debt and hybrid instrument. RWA. Risk-weighted assets. Assets weighted according to credit market or operational risk LCR and NSFR. Basel III. Ensure banks can meet short-term and long-term liquidity requirements. Implementation of Basel norms in India. India has adopted Basel norms in a phased and structured manner to align domestic banks with international standards. Basel I implementation. Introduced in 1992 by the RBI, all Indian commercial banks were required to maintain CAR of 8%. Basel II implementation. Phased implementation started in 2007. Banks were categorized into three groups. Group 1, large bank with significant international exposure. Group 2, mid-sized bank with moderate risk exposure. Group 3, small banks and regional banks. RBI issued guidelines for credit risk, market risk, and operational risk management. Basel III implementation. Phased rollout started in 2013 with full implementation by March 2019. Required banks to maintain higher capital buffers and meet liquidity requirements. RBI monitors compliance through periodic reporting and stress testing. Impact on Indian banks and financial stability. A stronger capital base. Banks now maintain higher capital levels, improving their ability to absorb losses during economic stress. Improved risk management. Adoption of advanced frameworks for credit market and operational risk has strengthened internal control systems. Enhanced transparency. Mandatory disclosure under Basel norms have increased accountability and improved stakeholder confidence. Higher financial stability. A more resilient banking system reduces the possibility of cascading bank failures and systematic crises. Better global compatibility. Indian banks now follow international standards, improving their credibility and enabling global integration. Strengthen supervisory oversight. RBI's monitoring, stress testing, and prudential regulations have become more effective. Improved asset quality focus. Banks have become more cautious in lending, leading to better assessment of borrower risk. Basel norms for Indian banking sector significance. The significance of Basel norms for Indian banking sector can be summarized as follows. Protection of depositors. Ensures banks have sufficient capital to safeguard depositors' money. Mitigation of systematic risk. Reduces the likelihood of banking crisis and financial contagion. Strengthening prudential regulation. Encourages disciplined lending, risk assessment, and transparency. Promoting sustainable growth. A stable banking system fosters confidence and supports long-term economic development. International integration aligns Indian banks with global banking practices, improving credibility in the global market, encouraging innovation. Risk-based regulation motivates banks to adopt modern risk management and technological solutions.